Hello, everyone, and welcome back to The Deep Dive, the show where we slice through complex topics and, well, pull out the juiciest insights, just for you.
Great to be back.
Today, we're plunging into a subject that might, at first glance, appear maybe as thrilling as watching paint dry. Cash equivalents and bank reconciliations.
Mm-hmm.
But trust me, by the time we emerge, you'll see why understanding these isn't just for, accounting wizards. It's fundamental to grasping the very pulse of any company's financial health.
Absolutely.
Our mission today, to arm you with some surprising facts and hopefully just enough humor to keep you hooked, turning what seems like dry financial concepts into, well, powerful knowledge. So let's unfurl this financial map, shall we?
Absolutely. Think of cash as the very lifeblood of a business.
Right.
Without a clear understanding of what constitutes that blood and how its flow is precisely managed and verified, you simply can't truly gauge a company's vitality.
Right.
We're not just defining terms today. We're dissecting why these concepts are so utterly critical for financial transparency, operational stability, and even, detecting potential red flags.
That's a powerful way to put it. When anyone assesses a company's financial standing, cash is usually the first thing they consider, right?
Mm-hmm. Definitely.
It represents immediate spending power, the ultimate measure of liquidity. Yet, the official definition of cash in the financial world goes beyond the physical dollars and cents you might have in your wallet.
That's right.
So for our dive, what exactly do we mean by cash when we're talking about a company's financial statements?
What's truly fascinating here is how the financial definition expands to capture availability. When financial professionals refer to cash, they're including currency, yes, the physical bills and coins,
So the obvious stuff.
but also what are termed demand deposits with banks or other financial institutions.
Okay, demand deposits. What's key there?
The crucial element here is demand deposits. This specifically means funds that can be accessed, added to, or withdrawn at any time without any penalties or prior notice. Think of it as truly ready money.
So it's not just the stack of bills maybe in the vault, but also the money sitting in accounts where a business can access it instantly, like a standard checking account.
Exactly.
That makes perfect sense. From a business perspective, that money is as good as physical cash for everything from paying employees' salaries to settling a supplier invoice.
Precisely. It's about that immediate, unrestricted accessibility, that instant liquidity. This immediate accessibility, this liquidity, is the absolute defining characteristic of cash. It guarantees that a company's funds are always readily available for its operations, allowing it to meet its immediate financial obligations, whether foreseen or unexpected, without delay, without having to jump through hoops, or incur additional costs to convert assets.
Okay.
It's the ultimate expression of current spending power.
Right, so that's cash.
Mhm.
Simple enough. But then we immediately encounter cash equivalents. Now, this is where things get really intriguing, because it broadens the scope just a bit. If cash is the main character, maybe cash equivalents are its super reliable sidekicks, almost as good as cash, but with a tiny bit more structure or a very short journey to become cash.
That's a great analogy.
They're like money that's just a whisper away from being truly spendable.
Yeah.
So what exactly are these cash equivalents, and what stringent criteria must they meet to earn such a critical place on a company's balance sheet?
That's a great way to put it. The term cash equivalents refers specifically to short-term, highly liquid investments. Now, to qualify for this classification, these investments must satisfy three very strict interlinked criteria.
Okay, 3 criteria. What's the first?
The first is that they must be readily convertible to a known amount of cash. This means there's absolutely no guesswork, no market speculation, and no significant process involved.
Oh.
You know precisely how much cash you'll receive when you convert them, and that conversion must happen easily and quickly.
So this isn't like trying to sell, I don't know, a vintage car or a piece of real estate where the price might fluctuate and the transaction could drag on for months.
Exactly right. No.
This is something that you could essentially liquidate with, like the click of a button, and you're certain of the exact cash amount you'll receive. Is that right?
Exactly. It's all about certainty and speed.
Yeah.
The second criterion is perhaps the most critical for understanding why these assets are treated almost like cash.
Okay.
They must be so near their maturity when acquired by the entity specifically, 90 days or less from the date of purchase.
Oh, okay, when acquired.
Yes. This isn't about how much time is left until maturity today, but rather the investment must have had a very short remaining life at the exact moment the company bought it.
Right.
This strict timing element is crucial for their short-term nature and stability from the very outset.
Ah, that's a subtle but wow, profoundly significant distinction. So, if a company buys a U.S. Treasury bond that has, say, 5 years until maturity, even if that bond is highly liquid, it wouldn't count as a cash equivalent.
Nope, doesn't make the cut.
But if they purchased a Treasury bill that only had maybe 60 days left until it matured when they bought it, then it could qualify, provided it meets the other criteria.
Exactly.
It's all about that initial purchase date.
Hmm.
That changes how I think about a company's investment strategy.
Precisely. This 90-day rule is fundamental because it directly minimizes the risk of significant price fluctuations. And that brings us seamlessly to the third criterion.
Okay, number 3.
These investments must present insignificant risk of changes in value. Because they mature so rapidly, their market value isn't expected to fluctuate meaningfully due to, well, whether it's interest rate shifts, market volatility, or other external forces.
So stability.
Exactly. This ensures their stability and reliability as a cash substitute.
So, to summarize, it's a trifecta. Super easy to convert to a known amount of cash, an incredibly short remaining life when purchased, and remarkable stability and value. That sounds like a financial tightrope walk almost, to get all three perfectly aligned.
It is quite specific.
But why do companies even bother grouping these with plain old cash? Why does this level of detail matter to us, the listeners, especially when we're evaluating a company's financial health?
Well, this grouping provides a far more accurate and comprehensive snapshot of a company's immediate financial muscle, its ready resources available to meet any short-term obligations.
Right.
When you encounter cash and cash equivalents on a balance sheet, you're not just seeing what's in the checking account, but all those highly liquid assets that can quickly and predictably be transformed into spendable money.
Okay.
This figure speaks directly to a company's immediate liquidity, indicating its capacity to cover urgent financial needs without having to, sell off long-term assets or borrow money. It's about assessing their operational agility.
Okay, that paints a much clearer picture of a company's immediate financial resilience. It's not just a big number, it's a reliable big number that tells you about their operational flexibility.
Exactly.
Now, let's dig into some concrete, real-world examples. What actual types of accounts or investments typically make the cut for cash and cash equivalents that we might encounter?
Certainly. Starting with the most straightforward, we have coin and currency on hand, which encompasses everything from the cash in a company's registers to its petty cash fund for minor expenses.
No, wait, the till money.
Yeah. Then there are the obvious ones we discussed. Checking accounts and savings accounts, which are classic examples of those unrestricted demand deposits.
Right, the funds a business can tap into whenever needed for day-to-day operations. What else falls into this highly liquid category?
We also include money market funds. These are investment vehicles that pool money from numerous investors to then invest in extremely short-term, low-risk debt instruments.
Right.
Because they target such stable, short-duration assets, they typically satisfy all three criteria. They're readily convertible, mature quickly, and carry insignificant risk of value change.
So if a company parks its excess cash into a money market fund to earn a little interest, that would generally be classified as a cash equivalent.
Yes, generally, provided it strictly adheres to all three criteria.
Got it.
Another category, often a bit misunderstood, is deposits held as compensating balances against borrowing arrangements with a lending institution that are not legally restricted.
Okay, that sounds nuanced.
It is nuanced. A company might agree with its bank to maintain a certain minimum balance in its account as a condition for, say, a line of credit or a loan. Now, if that money isn't legally tied up,
Meaning
the company can still access it for its general operations, even while it sort of compensates the bank for the loan agreement, then it qualifies as unrestricted cash. It's functionally available.
that's a crucial distinction. So while there's an agreement to keep the money there, the bank can't actually legally prevent the company from using those specific funds for daily business if needed.
That's the key.
So they're still considered available. Okay, what about negotiable paper? That sounds like a very broad and technical term.
It is, but it's quite important. Negotiable paper refers to financial instruments designed to be easily transferable from one party to another, essentially acting as a substitute for cash.
Okay.
They're called negotiable because their ownership can be transferred simply by delivery or endorsement, making them almost as fluid and reliable as physical cash for transactions.
Like what?
This includes instruments like bank checks, money orders, traveler's checks, bank drafts, and cashier's checks. These are essentially prepaid or guaranteed forms of payment that are immediately convertible.
Right, things you can just cash in.
Exactly. Beyond those, we also have commercial paper and treasury bills. Commercial paper consists of unsecured, short-term promissory notes issued by large, financially sound corporations to raise quick cash for short periods, typically less than 270 days.
Okay.
Treasury bills, or T-bills, are short-term debt obligations issued by the U.S. government with maturities of 1 year or less.
Very safe, very short.
Yes, both commercial paper and T-bills are classic examples of highly liquid short-term investments that almost always meet that 90-day acquisition rule and carry exceptionally low risk due to the creditworthiness of the issuers.
So these are basically extremely reliable, very short-term loans that a company makes, confident they'll get their money back quickly and predictably, often with a small return. It's strategic, but cautious.
Precisely. And finally, we have certificates of deposit, having original maturities of 90 days or less. This directly links back to that crucial near maturity when acquired rule.
Right, the 90-day thing again?
Exactly. If a CD matures within 3 months from the original date of purchase, it qualifies as a cash equivalent. If it's longer, well, it doesn't.
So all these examples collectively give us a much richer understanding of what actually shows up on a company's books when we talk about their ready cash. It's far more encompassing than just the checking account. This raises an important question, though. What's the strategic implication of grouping all these together? Why is it so vital to distinguish them?
For stakeholders, investors, creditors, financial analysts, this distinction is paramount. It allows them to assess a company's true financial liquidity and health, specifically its immediate ability to meet short-term obligations without financial strain.
Yeah.
It's not just about a large cash balance. It's about a reliable and available cash balance. This gives an indication of a company's immediate spending power and its capacity to remain financially nimble, seize opportunities, or weather unforeseen challenges in the short term.
Right.
It paints a vivid picture of operational flexibility.
That makes total sense. It's about more than just the number. It's about the quality of that number, its availability. But if some things make the cut, what gets left out of cash and cash equivalents? What investments, even if they seem safe, don't quite make the grade?
Well, the list of exclusions is as critical as the inclusions, as it draws clear boundaries for classification. Firstly, time certificates of deposit if original maturity over 90 days.
Ah, the flip side of the CD rule.
Exactly. If a company invests in a CD that matures in 6 months, for instance, it inherently fails that crucial near maturity when acquired rule we discussed.
Right.
Even if it's considered a safe investment, its longer maturity period means the funds are tied up for too long to be considered immediately available for general operations in the same way cash or cash equivalents are.
So even if it's a perfectly sound investment, it's just not fluid enough for that immediate liquidity category.
Precisely. And the other key exclusion is legally restricted deposits held as compensating balances against borrowing arrangements with a lending institution.
Okay, this contrasts with the ones that were included.
Yes. Remember the compensating balances that were included. The critical difference here is the legally restricted part. If a bank agreement legally prevents the company from accessing or withdrawing these specific funds for general use, effectively collateralizing them.
Like locking them up as security.
Exactly. Then even though they might be technically in the company's name, they are not available for operations. They're locked up and cannot be classified as cash or a cash equivalent.
That distinction between agreed upon and legally restricted is critical then. One implies functional control, the other implies a formal binding lockup. It's all about true accessibility. So these excluded items fail one or more of those core criteria: liquidity, ultra-short maturity, or insignificant risk. They need to be classified elsewhere on the balance sheet, right?
Absolutely. They would typically be presented in other asset categories like investments or other non-current assets, depending on the specific nature and purpose of the restriction or the maturity period. But they definitely don't belong on that immediate cash and cash equivalents line item, as they don't represent immediately available funds.
This brings us to another fascinating and I think often overlooked layer of complexity, the case of restricted versus unrestricted cash.
Yes, very important.
Imagine for a moment you're running a small business and you have a seemingly large sum of money in your bank account, but then you realize some of it has a giant sticky note on it saying, "Do not touch for daily operations. This is for the new factory in 3 years."
Right.
That's essentially what restricted cash is. It significantly impacts how financially flexible a company truly is, even if the total dollar amount on paper appears robust.
This classification isn't just an accounting nuance. It profoundly impacts how external parties, like investors and creditors, truly assess a company's immediate financial flexibility versus its long-term, often inflexible, commitments.
Okay.
Unrestricted cash is, well, it's the gold standard. It's what's used for all current operations, readily available for general use by the company.
Day-to-day stuff.
Exactly. This is the liquid fund for daily expenses, paying salaries, settling immediate supplier bills, and so on. It represents pure operational freedom.
So that's the truly free, flexible cash. But restricted cash sounds like it comes with some serious strings attached, potentially limiting a company's options.
It absolutely does.
Yeah.
Restricted cash is cash that has been formally set aside or earmarked for a specific use or purpose. It's not available for just anything.
Okay.
There are several ways cash can become restricted, and these distinctions are crucial. One common way is when it's contractually restricted.
Like with the bank.
Exactly. For example, if a bank agreement legally mandates that certain cash be held in a specific account, perhaps as part of a loan covenant, or to back a specific letter of credit, that portion should be separately reported as restricted cash on the balance sheet. This is a legally binding limitation.
So the bank, in essence, puts a legal lock on a specific amount of money, preventing the company from deploying it for general business needs until a certain condition is met or a loan is repaid. That sounds like a significant constraint.
It is. Another form of restriction is when it's management restricted.
Yeah.
This is equally important, even if it's an internal decision.
Oh, so the company itself can restrict it.
Yes. Even without an external legal agreement, a company's own management might choose to set aside a portion of cash for a future, very specific purpose.
Like what?
For instance, they might designate a pool of cash to be used exclusively for a significant capital expenditure, like purchasing a new production facility, or for a major future investment, such as acquiring another company.
Okay.
While not legally binding externally, this is an internal commitment that significantly limits its general availability for day-to-day operations or other immediate needs.
So even if it's just the company itself saying this specific money is reserved for that, it still counts as restricted cash. Wow. That really changes your perspective on how much truly available cash a company has at its disposal, regardless of the total balance. This means a company could appear cash-rich on paper, but be completely unable to seize a sudden growth opportunity or weather an unexpected downturn because their cash is legally or internally locked away.
It fundamentally alters the perception of a company's financial agility. And there are even some industry-specific nuances to be aware of.
Oh.
For example, certain regulated industries, like public utilities, might present their cash and cash equivalents as the last asset on the balance sheet.
The last. That's unusual.
It is unique because they often report assets in inverse order of liquidity, starting with the least liquid and ending with the most liquid, which is the exact opposite of what most other companies do under standard accounting practices.
Interesting.
It's a key detail for anyone analyzing their statement.
That's a fascinating quirk. So how does this restricted cash actually get reported on the balance sheet? Does it just get lumped in with everything else, or is it meticulously broken out?
Oh, it is meticulously broken out, and its classification depends entirely on the nature and timing of the restriction. If the restriction is associated with a current item, meaning it relates to a current asset or a current liability that will be settled within 1 year or the operating cycle.
The short term.
Right, the short term. Then the restricted cash is classified as a current asset. However, it must be presented separate from unrestricted cash. You might see it labeled as restricted cash current to denote its immediate but dedicated nature.
So still a current asset, but clearly distinct from the flexible cash you can use for everyday operations.
Yeah.
It's cash, but it's got a specific job assigned.
Exactly. Conversely, if the restriction is associated with a non-current item, such as funding for a long-term asset like a future factory purchase, or providing collateral for a long-term bond repayment fund.
Longer-term stuff.
Yes. Then the restricted cash is classified as a non-current asset. Again, it's displayed separately from other long-term assets like general investments or other assets. You might see it clearly identified as restricted cash non-current.
And I imagine there's a paramount requirement to explain why it's restricted, right? For full transparency, you can't just label it restricted and walk away.
Absolutely not.
The nature, the precise amount, and the timing of these restrictions must be clearly and comprehensively disclosed in the footnotes of the financial statements.
Ah, the footnotes again. Always read the footnotes.
Always. This disclosure is non-negotiable and crucial for transparency because it tells the complete story behind the numbers. It allows stakeholders to understand precisely why certain cash amounts aren't fully liquid or available for general use, adding vital context and nuance to the raw figures presented on the balance sheet.
Right.
For you, the listener, a critical takeaway is to always look at those footnotes. A large cash balance means little if a significant portion is restricted for long-term projects, effectively tying up liquid assets that can't cover immediate bills or be deployed for new opportunities.
This all makes me think about those specific, sometimes tricky situations where you might think you have cash on hand, but it's not quite what you believe. Let's really put this to the test with an example.
Okay, good idea.
We have Smith Corporation. Their cash ledger balance on December 31st, year 7, was $160,000. But then, when they were tidying up their books, they found some other items floating around. This is where the detective work begins. What adjustments do we need to make to truly determine their cash balance for financial reporting?
This example perfectly highlights the critical distinction between a company's internal ledger balance and its actual economic cash balance at a specific point in time. It underscores the absolute necessity for meticulous financial cutoff procedures.
Right. Getting that timing exact.
Exactly, to ensure accuracy for financial reporting and prevent misrepresentation of liquidity.
So Smith Corporation had a $5,000 check payable to Smith, meaning it was incoming cash for them. It was dated January 2, year 8. It wasn't included in their December 31 checkbook balance. What happens with that in our December 31 cash calculation?
Okay, that $5,000 check, even though it's incoming and payables to Smith, is distinctly dated January 2, year 8.
Next year.
Exactly. This means it explicitly belongs to the next accounting period. It's a future receipt that Smith hasn't yet earned or taken control of in year 7. Therefore, it correctly does not affect the December 31, year 7 cash balance.
Okay.
It's simply irrelevant for the current period's cash calculation and will be accounted for in the subsequent period.
Okay, that's straightforward. A future check is a future item. Makes sense. Next, they had a $3,500 check payable to Smith, which they had deposited on December 22 and had already included in their December 31 checkbook balance, so they thought they had it.
Right, they recorded it.
But then also, on December 22, it was returned as non-sufficient funds an NSF check. It bounced. It was later redeposited on January 2, year 8.
How does this impact our December 31 cash figure?
This is a crucial adjustment. Smith initially thought they'd received this $3,500 from a customer, and they'd already added it to their $160,000 ledger balance. However, the check bounced. This means the money was never actually received by Smith, and it certainly won't be reflected in their bank account as available funds on December 31st. Right, the bank kicked it back.
Exactly. Because they recorded money they don't actually possess, their book balance was overstated by this amount. Therefore, we absolutely need to subtract this $3,500 from their unadjusted balance. It's effectively phantom cash that needs to be removed.
That makes perfect sense. You can't count money you thought you had, but turns out you don't. It's like discovering an IOU from a friend who suddenly vanished. Okay, what about a $25,000 check, payable to a supplier and drawn on Smith's account? So this is money going out. It was dated and recorded December 31st, but was not mailed until January 15, year 8.
This is another key adjustment that often trips people up.
Yeah.
Even though Smith recorded this check as a payment on December 31 and likely reduced their internal ledger balance by $25,000.
They thought the money was gone.
Right. But they still had physical control of that cash on December 31. The check hadn't actually left their possession. It hadn't been mailed to the supplier. Critically, the money was still sitting in their bank account, fully available to them for other uses if needed. Because the check wasn't delivered to the payee until January 15th, the actual outflow of cash did not happen in year 7. Therefore, we must add this $25,000 back to the unadjusted balance to accurately reflect the true available cash Smith possessed and controlled on December 31st.
Wow. See how tricky this can be? It's not just what the bank says or even what your own ledger says. It's about what you truly had available and under your control on that specific date.
Exactly. Control is key.
It's a critical snapshot of liquidity that financial statements demand.
Yeah.
So to recap the calculation for Smith Corporation's true cash balance on December 31st, we start with their unadjusted cash ledger balance of $160,000. We ignore the check dated next year. We add back the $25,000 check that wasn't mailed until January because that cash was still effectively there.
Still under their control.
And we subtract the $3,500 NSF check because they never truly received that money.
Correct. That leads us to a precise adjusted balance of $160,000 plus $25,000 minus $3,500, which results in $181,500.
$181,500.
Yes. This is the accurate, truly available cash amount Smith Corporation should report on its December 31, Year 7 balance sheet. This example vividly underscores the critical importance of proper cutoff procedures at the end of an accounting period.
Yeah.
Without them, a company's financial picture could be significantly distorted, leading to misinformed decisions.
That's a perfect segue into our next major topic, bank reconciliations. It's the ultimate financial detective work, really.
Uh-huh. It can feel like it sometimes.
Have you ever looked at your personal bank statement and thought, wait, that balance doesn't quite match what my budgeting app says I have?
Oh, definitely.
Well, companies deal with the exact same phenomenon, but on a vastly larger, more complex scale. That's precisely where bank reconciliations come in. They are the essential process for solving the mystery of why a company's internal records don't perfectly match the bank's records.
This process is absolutely fundamental for robust internal controls and achieving accurate financial reporting. The primary overriding goal of a bank reconciliation is to methodically account for and clearly explain any and all differences between the cash balance reported by the bank on its monthly statement and the cash balance recorded in the company's own records, often referred to as the depositor's books.
Okay.
These differences aren't necessarily errors, I should stress. They naturally occur due to various factors, usually related to timing lags in recording or information flow.
Right, timing differences.
Exactly. It's about ensuring the integrity of the cash balance, which is often a company's most active and liquid account. It's really about trust in the numbers.
So it's about getting both sets of numbers, your books and the bank's, to agree, and perhaps more importantly, truly understanding why they didn't agree in the first place.
Precisely. Understanding the why is key.
Let's delve into the specific components that typically create these differences in a standard or, let's say, simple bank reconciliation. What's the first major discrepancy we often encounter?
The first, and perhaps most common discrepancy, involves deposits in transit.
Okay, deposits in transit.
These are funds that the company has already deposited with its bank and has duly recorded as an increase in cash in its own books. However, the bank has not yet processed or recorded these deposits.
Why would that happen?
It frequently happens if a deposit is made late in the day, after the bank's processing cutoff time, or very near the end of a reporting period like month end.
Okay.
The immediate impact is that the bank's balance will appear lower than the company's books. To bring the bank's balance into agreement with the company's, you need to add these deposits in transit to the bank balance side of the reconciliation.
Got it. So your company knows to put the money in. It's already in your internal record, but the bank hasn't quite caught up yet with its processing. Makes sense. What about the inverse of that scenario? Payments that the bank hasn't yet recorded.
That brings us to outstanding checks.
Yeah.
These are checks that the company has already meticulously written and issued for payment to a supplier, employee, or other payee. The company has, of course, already recorded the payment in its own books, thereby reducing its cash balance. However, these checks have not yet been presented to or paid by the bank.
They haven't cleared yet.
Exactly. So from the bank's perspective, the money is still in the account, making the bank's balance appear higher than the company's books. To reconcile, you must subtract these outstanding checks from the bank balance.
Okay. So the company knows the money is earmarked or effectively gone, but the bank hasn't seen the check come through its processing system yet. It's like a check sitting in someone's mailbox, maybe, waiting to be cashed.
That's a good way to think about it.
What about those little deductions or additions the bank makes directly to your account that you, as the company, might not know about immediately?
Right. That leads to service charges. These are various fees, sometimes small, sometimes substantial, that the bank directly deducts from the company's account for services rendered.
Like monthly fees.
Could be monthly maintenance fees, fees for printing new checks, or charges for processing returned items, things like that. The company usually remains unaware of these charges until it receives and reviews its bank statement. Until these charges are recorded, the company's internal book balance is overstated because it hasn't yet accounted for the reduction due to the fee. Therefore, you subtract these service charges from the book balance.
Okay, so the bank took the money, and now you, the company, need to adjust your own internal records to reflect that outflow. What if the bank actually adds money to your account that you weren't expecting to see on your side?
That commonly occurs with bank collections. In these scenarios, the bank acts as an agent, collecting money directly on the company's behalf.
An example.
A classic example is a customer directly paying a note receivable owed to the company straight into the company's bank account. The company typically won't be aware of this specific collection until they review their bank statement.
Right, it just appears.
Exactly. Prior to recording this, their internal book balance would be understated because they haven't yet accounted for this incoming cash. Therefore, you add these bank collections to the book balance.
It truly is like solving a complex financial puzzle, isn't it? Trying to meticulously figure out why your internal ledger doesn't quite align with the bank's records.
It really is.
Each of these items we're discussing is a crucial piece of that puzzle, and once you understand what they represent, the entire reconciliation process becomes surprisingly clear, actually. What about plain old mistakes? Those happen, right?
Oh, indeed. Errors are another significant, albeit less systematic, cause for differences. These could be mistakes made by either the bank or the depositor of the company.
Either side could mess up.
Absolutely. It could range from simple transposition errors, like writing $120 instead of $102, to posting a transaction to the wrong account entirely. The adjustment for errors simply involves correcting the amount on the side, whether it's the bank's records or the company's books, where the mistake originally occurred. The specific impact will, of course, vary depending on the nature and magnitude of the error. This is where the detective work truly comes in.
Finding who made the boo-boo, and what about that dreaded NSF check we discussed earlier with Smith Corporation, where money you thought you had turns out not to be there?
Yes, non-sufficient funds, NSF checks, are a very common and frustrating adjustment for companies. This situation arises when a check that the company deposited and subsequently recorded as a receipt in its internal books bounces or is dishonored because the payer had insufficient funds in their own bank account.
Right.
The bank will then charge this check back to the company's account, reducing its cash. This means the company's book balance is overstated because they initially recorded money they ultimately did not receive.
So you have to take it back out of your books.
Correct. To rectify this, you must subtract the amount of the NSF check from the book balance. It's money you thought you had, but it vaporized.
So it's a negative surprise that requires your books to reflect reality. And finally, what if your bank account is actually earning money for you, quietly accumulating interest?
That brings us to interest income. If a company's bank account accrues interest, the bank will automatically add this amount to the balance.
Nice little bonus.
It is. Typically, the depositor doesn't track this on a daily basis and won't know the exact amount until the monthly bank statement arrives. Until this interest is formally recorded in the company's books, their internal book balance is understated.
Because they haven't recorded the income yet.
Exactly. So to accurately reflect the true cash, you add this interest income to the book balance.
This granular detail is truly essential because each item we've discussed represents a specific timing difference or an information lag between the bank and the company. Correctly identifying and meticulously adjusting for each of them is what leads us to the true cash balance, which is the only figure that truly matters for accurate financial reporting. So how do we put all these individual pieces together? What are the actual systematic steps in performing a simple bank reconciliation?
Well, the elegant symmetry of a bank reconciliation, where both sides ultimately converge on the exact same true cash balance, provides an incredibly powerful internal control mechanism.
Right, that matching aspect.
Yes.
Yes.
The most common and effective procedure is to meticulously reconcile both the company's internal book balance and the bank's bank statement balance to this common, correct, true cash balance. This singular true balance is the precise amount that should then be reported on the company's balance sheet under the caption cash and cash equivalents.
That's the number that goes on the financials.
It's the verified, undeniable truth.
So it's a two-sided equation, a dynamic balancing act, bringing both your internal records and the bank's external records into perfect harmony to find that single correct number. How do you initiate this process? Which side do you typically start adjusting?
You typically start by adjusting the book balance. You take the company's raw ledger, balance the cash figure according to their own records, and systematically adjust it for any corrections that the bank has already reported, but the company hasn't yet recorded.
Okay, things the bank already did.
Exactly. This critical category includes items like the NSF checks we just discussed any notes collected directly by the bank on the company's behalf and credited to the account, all monthly bank service charges, and any other bank-initiated charges, such as fees for check printing.
Right.
These are essentially the pieces of information the company learned about from the bank statement and now needs to incorporate into its own books.
Okay, so these adjustments primarily affect my internal books, not the bank's, because the bank has already processed and accounted for them on their side. They're simply giving me the news, basically.
Exactly. After these precise adjustments are made to the company's records, the resulting figure is what we call the adjusted book balance. If done correctly, this figure now represents the true balance.
The target number.
Yes, this is the accurate, verifiable cash amount that genuinely exists and unequivocally belongs to the company at that specific point in time, ready for financial reporting.
And then you switch perspectives and take on the bank side of the reconciliation to make sure it matches.
Yes, the very next step is to reconcile the bank balance to the true balance. You begin with the cash balance, as explicitly stated on the book's monthly statement. Then, you adjust this balance for items the company already knows about and has already recorded in its internal books, but the bank has not yet processed or recorded.
Okay, the opposite situation.
Exactly.
Yep.
These key items are primarily deposits in transit funds the company deposited, but the bank hasn't logged, and outstanding checks the company wrote, but the bank hasn't yet honored or paid.
So it's truly like a mirror image of the first step, where each side of the reconciliation, the company's books and the bank statement, gets adjusted for the things the other side already knows or has completed.
Precisely.
And the real magic, the moment of truth, is when both paths lead to the exact same destination, that verified true cash balance.
Exactly. If both your calculated adjusted book balance and your calculated adjusted bank balance converge and match down to the last penny, you've successfully arrived at the correct true cash balance to be reported.
That's the goal.
It is. This convergence provides immense confidence in the accuracy and reliability of the reported cash figure, which is a critical step before any financial statements are issued to investors or regulators. This process is a frontline defense against fraud and error.
Let's truly solidify these concepts by running through a practical example. We have Burbank Company.
Okay.
Their internal records reflect a cash balance of $12,650 on November 30, year 3. However, their November bank statement shows a different cash balance, $10,050.
A common scenario.
Right. To complicate matters slightly, we also know about a $10 bank service charge, an NSF check for $90, deposits in transit amounting to $3,000, and outstanding checks totaling $500. So how do we systematically find Burbank's true adjusted cash balance as of November 30?
This practical example truly solidifies the theoretical concepts we've discussed. It elegantly demonstrates how seemingly minor discrepancies can be systematically resolved to arrive at an accurate financial picture, which is precisely what users of financial statements rely on.
Okay.
Let's start with the company's internal books, the book side.
So Burbank's starting cash balance, as per their own books, is $12,650. What adjustments do we need to make to their book balance based on the information we just got from the bank statement?
Okay. From reviewing the bank statement, Burbank learned about the bank service charge of $10. This is a legitimate expense that reduces their available cash, so we must subtract it from their book balance.
Sure.
$12,650 minus $10.
Okay.
They also discovered the NSF check for $90. This means money they thought they had isn't actually there. It bounced. So we must subtract that as well. Minus $90.
So, for Burbank's books, we start with $12,650, then subtract $10 for the service charge, and subtract $90 for the NSF check. That gives us $12,650 minus $100, which results in an adjusted cash balance books of $12,550.
Correct.
That's our provisional true balance for now. Now let's see if the bank side of the equation magically aligns.
Okay, for the bank side, we begin with the balance explicitly stated on the bank statement, which is $10,050.
Right.
We know about deposits in transit of $3,000. These are deposits Burbank made, but the bank hasn't yet recorded on its statement for this period, so we add them to the bank balance. $10,050 plus $3,000,
Bringing it up.
which brings it to $13,050.
Okay. And then we factor in the outstanding checks, which the bank hasn't yet seen or processed.
Exactly. The outstanding checks total $500. These are checks Burbank wrote and recorded, reducing their cash, but they haven't yet cleared the bank. So from the bank's perspective, the money is still in Burbank's account, making the bank's balance appear artificially high.
So we take those out.
Correct. To correct this, we subtract these outstanding checks from the bank balance. $13,050 minus $500.
And that brings us to an adjusted cash balance bank of $12,550.
It matches.
Exactly. This is the moment of truth. Notice how both paths, starting from two different raw figures, Burbank's books and the bank statement, lead to the exact same destination. That's the elegant beauty and confirming power of a well-done bank reconciliation. It confirms accuracy from two independent angles. And that $12,550 is the verified true cash balance Burbank should report.
It is the ultimate validation. The fact that both adjusted balances precisely match instills absolute confidence in the accuracy of the reconciliation and, by extension, in the integrity of the reported cash figure. It's a fundamental control that any financially healthy organization relies upon.
So that was a simple reconciliation, giving us a snapshot of cash at a single point in time. But of course, in finance, there's always a deeper dive to be had, right?
Always more complexity if you want it.
We have something far more comprehensive called the four-column reconciliation, also widely known as the reconciliation of cash receipts and disbursements, or more simply, a proof of cash.
Yes.
This sounds like it goes well beyond just balancing ending figures. It's almost like a full financial audit just for the cash account.
You've hit on its core strength. This method offers an incredibly robust audit trail. While the simple reconciliation is indeed like taking a single snapshot of cash at a moment in time,
Right.
the four-column reconciliation is like creating an entire movie. It meticulously tracks how the cash flowed in and flowed out over an entire period, making sure every single transaction lines up perfectly.
Wow.
Its primary purpose isn't merely to reconcile ending balances, but to serve as a comprehensive proof of the proper recording of all cash transactions across an entire period, typically a month. It's a more complete dynamic verification tool.
So it's not just checking the beginning and end points, but verifying every single step of the journey, ensuring the integrity of the cash flow itself. That sounds powerful. What kind of additional information do you specifically need to perform this more detailed, multi-dimensional reconciliation?
Crucially, it demands bank reconciliation information for both the present month and the prior month.
Oh, you need last month's data, too.
Yes. This retrospective component is what allows for the meticulous tracking of cash flow over time, connecting the beginning balance to the ending balance through all the receipts and disbursements. It's about understanding the progression, not just isolated points.
Okay.
Specifically, it reconciles two main sets of differences. First, the disparities between the depositor's recorded cash receipts and the bank's recorded deposit for the period. And second, the differences between the depositor's recorded cash disbursements or payments and the bank's recorded checks paid.
Okay, so it reconciles the flows as well as the balances.
Precisely. The power of this four-column approach lies in its unparalleled ability to pinpoint precisely when and where any discrepancies occurred, whether in the inflow of money, the receipts, or the outflow, the disbursements. It provides a complete granular audit trail of all cash activity, offering an unparalleled level of financial control and verification, making it a powerful tool for preventing and detecting fraud or errors. It's a mastery of financial control, really.
Let's look at a comprehensive example for Burbank Company's December reconciliation using this four-column approach. It's typically laid out in a table, right, with four primary columns: beginning balance, receipts, payments, and ending balance.
Correct.
With rows for both the depositor's books and the bank records.
Yes, let's walk through this powerful tool step by step. We begin with the foundation, the adjusted balances from November 30, year 3, which we just meticulously calculated in our simple reconciliation.
That $12,550 we found.
Exactly. That verified $12,550 becomes the precise starting balance 11/30 year 3 for both the book and bank sides in this new, more comprehensive reconciliation. It's our anchor point for the period.
Okay, so that's our perfectly balanced baseline. Now let's zero in on the receipts column, which represents all the money flowing in during December. Burbank's internal books initially show $12,950 in total receipts for the month. What specific adjustments do we need to make here, and crucially, why?
Okay, first, we see a note collected by bank for $3,050. This signifies money the bank collected on Burbank's behalf from, say, a customer paying an outstanding note directly to the bank.
Right, like in this simple rec example.
Exactly. Burbank wouldn't have known about this until they reviewed their bank statement. So to accurately reflect the cash they truly received, we add this $3,050 to Burbank's book receipts.
Okay, add it to the book side. What about the bank side?
On the bank side, the bank already processed and recorded this, so it would simply be part of their total deposits for the month. It's already baked into their numbers for December.
Got it. And what about that troublesome NSF check received from customer for $285? That's money Burbank thought they received, but ultimately didn't because the check bounced.
Right. If Burbank initially recorded this as a cash receipt, they now need to reverse that because the money was never actually collected. So we subtract $285 from the book receipts.
Okay, subtract from book receipts.
And on the bank side, the bank would have processed the bounced check, effectively reversing the initial deposit, so it also reduces the bank's recorded receipts for the period. It's a deduction on both sides to reflect that the cash never truly materialized.
Okay, that makes sense. Both sides need to acknowledge it wasn't real cash. Now, here's where it often gets a bit intricate with the deposits in transit. We have deposits in transit from November 30 for $3,000. These are last month's deposits still hanging out there. And then we have new deposits in transit for December 31 of $4,000 this month's pending deposits. How do these two distinct types of deposits in transit affect the December receipts on the bank side of our reconciliation?
This is absolutely crucial for understanding the chronological flow. Think of it this way for the bank side. When we look at December's bank statement, we need to adjust for things the bank is catching up on from last month and things they haven't seen yet for this month.
Okay.
So the deposits in transit from November 30, $3,000, were deposits Burbank made at the very tail end of November. The bank didn't record them in November, but they finally hit the bank this December.
So the bank sees them now?
Right. Therefore, they get added to the bank's December receipts because that's when the bank actually processed them and increased Burbank's account.
Ah, so the bank is finally recognizing last month's deposits in this month's figures. That makes perfect sense.
Exactly. Conversely, the deposits in transit for December 31, $4,000, are deposits Burbank made at the very end of December, but which the bank hasn't yet processed or recorded.
Not yet on the statement.
Right. Since we're trying to reconcile the bank's recorded receipts for December, we subtract these December 31 deposits from the bank's December receipts because they won't actually appear on the bank statement until January's statement. They are simply not part of December's bank processed receipts.
Okay, that's clear. So the bank's initial total December receipts of $15,000 get adjusted for last month's deposits finally coming in, $3,000 added, and this month's deposits that haven't been counted yet, $4,000 subtracted.
Correct.
And after all those adjustments for the note collected and the NSF check, both the book and bank receipts should beautifully converge on the same adjusted receipts figure, which in this detailed case would be $15,750. It truly reveals the flow.
Correct. If we trace the calculations, the total calculated book receipts are $12,950 initial, plus $3,050 note collected, minus $285 NSF check equals $15,715.
Okay.
And the total calculated bank receipts are $15,000 initial, plus $3,000 the NOV-DIT, minus $4,000, the DIT, minus $285 the doing tax check, also equals $15,750.
Say match. Perfect.
Right. Yes, they match, which is the undeniable goal and the validation of our receipt reconciliation.
Now let's turn our attention to the payments column, representing all the money going out during December. Burbank's books initially show $4,948 in payments. What happens here?
Okay, we have a bank service charge of $15. Just like with the receipts, this is an expense Burbank needs to formally record. It reduces their cash, so we add $15 to Burbank's book payments, bringing their total recorded outflows to reflect this fee.
Add it to the payments, okay. And then there's an error in recording check num $354 for $54. This sounds like an accounting stumble.
This is a classic example of a book adjustment due to an internal error. For instance, maybe Burbank intended to write a check for $100, but mistakenly recorded it in their books as only $46.
Ah, understated the payment?
Exactly.
Okay.
Then their book payments would be understated by $54. To correct this, we would add $54 to the book payments, ensuring their records accurately reflect the full amount of the disbursement. The direction of the adjustment always depends on whether the original error caused an overstatement or understatement.
Got it. Correcting the book error. What about the outstanding checks in this 4-column reconciliation? We have outstanding checks from November 30 for $500 and new outstanding checks for December 31 of $3,402. How do these affect the December payments on the bank side?
Okay, similar logic to deposits in transit. The outstanding checks from November 30, $500, were checks Burbank wrote in November, but the bank didn't pay until December. So these are now added to the bank's December payments because that's when the bank actually processed them and deducted them from Burbank's account.
They finally cleared.
Exactly. They're finally clearing in December.
So the bank is finally catching up on those checks from last month. It's verifying the outflow.
Precisely. And the outstanding checks for December 31, $3,400 are checks Burbank wrote in December that the bank hasn't yet paid.
Not cleared yet.
Right. Since we're looking at the bank's recorded payments for December, we subtract these December 31 outstanding checks from the bank's December payments, as they will only be processed and appear on the bank statement in January. They haven't cleared yet.
Okay, this table might look a bit intimidating at first glance, I admit, but once you break it down piece by piece, it's just a systematic way of making sure every single cash transaction in and out is accounted for and matched up. It truly is a masterpiece of financial reconciliation.
It really is quite elegant in its structure.
After all those meticulous adjustments, both the book and bank payments should converge on the same adjusted payments figure, which in this case is $5,017. And the ultimate proof, the final validation, is in the final ending balance column for December 31st, year 3.
Indeed. The profound beauty of this four-column method lies in its comprehensive nature. Every single column, the beginning balance, total receipts, total payments, and the ending balance, should meticulously reconcile a match between the book and bank figures.
Every column should balance.
Yes. For December 31st, year 3, our adjusted ending balance for both the book and bank side should converge perfectly at $23,248. This level of verification ensures a complete, accurate, and deeply insightful picture of a company's cash flow activity throughout the period, not just a static balance. It's vital for auditing, fraud prevention, and strategic cash management.
And there you have it, a comprehensive deep dive into the surprisingly nuanced yet absolutely vital world of cash, cash equivalents, and bank reconciliations.
We made it through.
We did. From understanding what genuinely counts as cash and how its availability impacts a company's agility, to how businesses meticulously balance their books to ensure financial integrity, you now have a real shortcut to being truly well-informed on this foundational financial topic.
Indeed. Understanding these foundational elements of cash and its systematic management isn't merely an exercise for accountants, as you said earlier. It reveals the meticulous rigor required to maintain a company's financial integrity and liquidity, the very lifeblood of their daily operations.
Right.
It's a testament to the systematic processes necessary in finance, and why such transparency through detailed reporting is so essential for all stakeholders. It's really how businesses avoid crippling cash crises.
So the next time you glance at a company's cash balance on a financial statement, you'll know there's an entire intricate process, a true dance of numbers behind that single figure, ensuring its accuracy and revealing its true nature, restricted or unrestricted. And perhaps this leads to a final thought for you, our listeners, to mull over. How might a deeper understanding of these precise reconciliations give you a unique edge when evaluating financial news? Perhaps spotting a subtle red flag in a company's seemingly strong cash position, or maybe even just optimizing the management of your own personal finances, ensuring your bank statement truly reflects your freely accessible funds.
A very relevant question.
Until next time, keep diving deep into the fascinating world of finance.